to Economics Lectures with Mr. Burns. Hello, Mr. Burns.
Hello, Mr. Smithers. How are you this afternoon?
Good. And SAC next Tuesday, so we will bang this out and get it up for you on YouTube so you can do some revision over the weekend. So we'll try and be more succinct than usual, but no doubt we'll fail. All right, let's start with monetary policy. Straight to the cash rate.
Right, here we are. Well, of course, the primary operating target, monetary policy, is the cash rate. What they use to manipulate. Well, this is the cash rate, the rate that is. I'm talking rubbish. Take over, Mr. Smithers.
So, well, let's have a look at where we're at now. I mean, we are at a record low. 50 years, we haven't been down here at 2%. Even during the GFC, they said an emergency setting was sitting there at 3%, and they even said in their statements that this was 3%. So what we're seeing is a new normal in interest rates that where people our age are just sort of getting used to how low they are.
Very much so.
And we'll come to talk about stance later. But I mean, the most obvious thing that we've got in the last 4 years that you guys need to know about is this direction from what I think was an attempt at being fairly neutral around here to certainly an expansionary or accommodative stance. But I mean, this is the tool. This is monetary policy. It's the setting of the cash rate, and that is what the Reserve Bank do. That's their main game. That's the main weapon in their arsenal. And we can probably move on straight to the primary objective of monetary policy, which is
consumer price inflation, to keep it between 2 to 3%. We saw recent CPI data showing that we're in that. We're actually below that at 1.5. The quarterly figure came in at 0.7%. Don't forget, the RBA do look through the CPI data, though, and look at what's sometimes called the underlying rate or the trimmed mean, although I think they call it core inflation in some other parts of the world. The idea is they take the volatile items out. So this is still the technical operating target, the CPI, but the RBA will consider the underlying rate as well in setting interest rates.
And they'll look through short-term fluctuations. So the recent inflation data is, as you guys should know, the headline rate was 0.7, and I think that the underlying was 0.4, mainly because of petrol prices. And so they will look through those short-term, particularly supply-side shocks to prices, to set the cash rate for the medium term, their medium term sort of look at inflation and where they think it's going to be. So again, the last time we had high interest rates, I think, was when we had inflation just before the GFC getting up to above 4%, and they were hiking up rates as a result. And we saw, even in the year of the GFC, 2 interest rate rises at the start of that year. And that was because their primary aim is, and it's well stated on their website, is to maintain consumer price inflation of between 2 and 3% over the course of the business cycle.
Which allows it to peak above and below, so they don't panic if it goes above or below, but the idea is it's over that business cycle, so it gives them a little bit of wriggle room in that environment, which is important.
And you can actually see they've been quite successful at it. So if we shade this band, I mean, there hasn't been a lot out of control, and they can explain some of the fluctuations, such as the GST in 2000 and that sort of thing. So, they've been quite successful as a central bank in that primary goal.
And don't forget, some people talk about inflationary targeting. This is what inflationary targeting is: targeting an inflation rate or range of inflation, such as we have here. But of course, jumping to the next slide, it's really about. Monetary policy is about, certainly they've got that target for inflation, but it's about how interest rates influence economic activity. And it's not the cash rate that influences economic activity directly, it's the other rates in the economy. It's the other interest rates, it's mortgage loans, it's small business loans, it's large business loans, it's personal loans. These rates are the rates that people, businesses, households take out on their loans or receive income from their loans, and these are the things, changes to these rates affect people's behaviour and affect ultimately economic activity and prices, and that's really what we need to talk a little bit about now. So we've got a couple of slides coming up which show the link between the cash rate and the small business interest rate.
Yep, so I mean, that's how you explain those through those transmission mechanisms that we've talked about in class, those separate ones, which we'll talk about a bit in the next couple of slides.
So you can see how the other interest rates follow clearly the cash rate.
There's the cash rate.
And then you've got, what do you term loan, residential security, you've got small business loans. I mean, these are loans to Australian small businesses, and they're following in that direction. Quite low, quite stimulatory when you consider it historically speaking, but you see there is a gap between the cash rate and the other rates, which is effectively, if you wanted to think about it, you could argue it's not technically, but it's a bit of a margin for the banks.
So the difference between here and here is what we're saying is that is basically the margin that the bank makes on those loans that they lend out.
Effectively. And then jump to the next slide, you see you've got other lending rates in small business and large businesses. There is a difference, interestingly enough.
And that would be because the large businesses are less risky for the banks.
Exactly. So it's a risk versus return or risk aversion concept. So small business people pay a higher rate of interest.
And is the same reason why you've got higher rates for credit cards as you do for mortgages, as you guys should well be aware.
Okay. So this is probably I find the more exciting part of monetary policy, the stance of monetary policy. And these terms are thrown around. You do need to understand what they mean. Loose monetary policy, accommodative monetary policy, expansionary monetary policy are all the same thing effectively. And there is a trick in it though. You can have, I don't want to confuse people, you can have a loosening monetary policy, but it could still be a contractionary phase. For example, if we had the cash rate, say, at 10% and it dropped to 8%, you could argue it's a loosening of monetary policy, but the actual stance could still be contractionary. Clearly, the current stance at the moment, Mr. Smithers,
is loose, it's accommodative, and it's expansionary.
And then we've got the question here that you do need to be able to grapple with, students, is how does this work with the other macroeconomic policy tool, fiscal policy? How does it work with fiscal policy? Is it conflicting or compatible? And we'll answer that in a minute, but just before we do, we want you to think about that yourselves and how you would answer that question. Channels or transmission mechanisms. Do you want to talk about the first one, Mr. Smithers?
So, cash flow. This is quite simply just think of someone with a mortgage and it's the available cash they have after paying back the monthly amount on their mortgage. So if their interest rate goes down, they pay less servicing that debt. They have more money with which to spend on other goods and services in the economy. Therefore, that should stimulate growth. So the 2 times that we've seen loosening this year from in February and May from 2.5% down to 2%, people with debt, and that's businesses as well, but if you just think of someone holding a lot of debt, like someone with a mortgage,
you, Mr. Smithers,
like me, as my class well knows,
on that mansion of yours,
you will see a reduction in your, if you've got a variable loan, which most people do, you'll see a reduction on the amount you have to pay in servicing that debt. That leaves you with more money, and that is what we call discretionary income.
Very important point.
Not disposable.
Not disposable. That's
very important, and that's, as we've both probably drummed home to you, that's been written up in just about every examination report in the last 10 years. So that's the cash flow.
But one thing to pick up on the cash flow is it's less effective if people use that increase in discretionary income to simply pay down their loan, i.e. to reduce their debt. Timmy, on the article that was handed out to you, she talks about deleveraging. The one called Economics Unit 4 Monetary Policy is a macro demand management tool. Deleveraging is effectively, if you've got instead of when interest rates fall, instead of Mr. Smithers taking that increase in discretionary income and going out and buying his wife jewellery and taking her shopping and going to restaurants or buying himself golf clubs, he uses that to effectively pay down his loan and have less debt. And so that's one of the issues there with that channel.
Yes, and my preference is, of course, to pay down the debt, but as everyone in my class knows, we're planning on doing an extension, so we are going to take on some more credit.
And that leads us to the cost of credit channel, quite a simple one here. If it costs more, if interest rates go up, for example, it costs more for businesses to borrow, they will borrow less and expand less, if you like, or invest in less capital goods or capital expenditure or CapEx. And same with households. If it goes up, for example, if tomorrow interest rates, let's say this or next week, when the Reserve Bank comes out, they say we're going to increase interest rates by 200 points, will you go ahead with your renovation, Mr. Smithers?
Yes.
You will?
Yep.
But it would be a smaller renovation?
Possibly.
Yeah, there you go.
All right. Now the exchange rage, that probably should say rate, but
there's a bit of rage about the exchange rate though going along. So.
There is for those people going to America later this year. I'm very nervous about it. Now the exchange rate, of course, looks at the relative interest rates of Australia versus overseas trading partners, and if we particularly look at the US, they're in a phase where they're looking to put up interest rates. We're loosening monetary policy. Now that differential will determine our exchange rate. Now you will see that our dollar has come down against the US this year, and that exchange rate effect as a result of the change of relative interest rates has seen the dollar to be less attractive in foreign exchange markets, and therefore the value or the demand for that go down, and therefore the value of our exchange rate go down. So as that happens, we should see the exchange rate channel kick in, and our exports become more competitive, more cost competitive, and imports become more expensive. And this should have a positive effect on aggregate demand through net exports. So we should export more and import less.
We do talk a little bit about this later on. I've got a couple of graphs later on. I might just jump to the next slide. We will discuss the asset price effect. We'll do that when we're looking at the housing graph. So I've got retail sales growth here. We put this in purely to show you that monetary policy is starting potentially to tick up retail sales growth through perhaps the cash flow effect. It's only a turnaround. And confidence, the drop in confidence could explain perhaps the drop, but there is some green shoots emerging here, and you could attribute this to the cash flow effect, perhaps as interest rates are down, consumers are feeling have greater, and the asset price effect as well, greater sense of wealth or greater discretionary income. What have I got here? Lending rates. This is another example of the situation around cash flow effect. As household lending rates have fallen, consumers have more money available to them. We jump to housing prices. So the asset price effect we haven't discussed, and this is a really, you're not Australian, or you're certainly not a Melburnian or a Sydney-sider if you don't talk about house prices every day or every minute effectively. And as you can see, Sydney and Melbourne have had some pretty strong growth in house prices in recent years. And one of the consequences, there are good things and bad things about this, and certainly the asset price effect argues that as interest rates fall and asset prices goes up, people feel more confident, they feel more wealthy, and therefore they will spend more. And psychologically you can understand that. If the house in your street goes for an extra $100,000 when it sells than perhaps you thought it was going to, or more than when you bought your house just recently, you think suddenly I'm wealthier, therefore I might go on a holiday, I might spend more money on other things. And there is an element of truth in that. So that's known as the asset price effect.
And the bank will be more happy to lend against that increased value. So you can incur more debt by taking on those holidays, etc.
Exactly. Now there is a downside to high house prices, and we'll talk about that a little bit later on. Household savings ratio we put in here just to show that as interest rates have come down in recent years, we have seen a decline in the household savings ratio just in the most recent period. Now, as everyone in my class should know, if you're saving less, hopefully you're spending more. Well, you have to be if you're holding taxes constant. So that's just a simple mathematical scenario or relationship. So we are, again, this is sort of something I'm referring to as green shoots, as the household savings ratio has started to decline. This is indicative of consumers spending more, retail sales starting to pick up, and we're starting to see potentially some improvements in consumption growth. It's still flat, but as the Reserve Bank Governor said, it is picking up, although it is below trend.
And I think one of the reasons we're talking about the impact of monetary policy and whether it's as impactful as it used to be is that we can see here that this, the transmission mechanism, particularly of the cash flow effect, just hasn't worked as well as it has in the past because of this stubbornness or this new normal of households to save more money and to put aside, to pay off down debt rather than to go whoopee in the economy like they were doing down here pre the GFC.
And that's where they were, a negative savings ratio, so you're spending more than you're earning, and that was underpinning some significant growth in consumption. And we were all amazed that consumers could continue, or the household sector could continue to spend like they were, like the drunken sailors. it didn't last, clearly. We talked about this a little bit earlier, and I just want to bring up the term interest rate differentials. Mr. Smith has referred to as relative interest rates, means the same thing, and how they work. And if you jump to the next slide, we've got clearly some really interesting cash rates here. I mean, just look at this, students. This is unheard of. You know, cash rate in the United States around 0 or 0.25. Japan's been flat for a long time. Euro's come down. I mean, we have incredibly stimulatory, accommodative monetary policy around the world at the moment. The world is awash with cash. And it's surprising that we haven't seen growth rebound as quickly as it had. There's lots of reasons for it. Confidence is a key part of it. Significant issues around the hangovers from the GFC, massive devaluation in house prices, particularly in America. You've got the Greek exit situation or European lack of confidence. So there's some major reasons, but that's a pretty significant fall in interest rates from above 5% right down to 0 in the United States. Of course, if you're paying attention to current economic conditions, students, you'd know now that they are talking about interest rates rising in America towards the end of this year. And this is explaining some of the depreciation in the Aussie dollar. It means the gap between our currency and the rest of the world will diminish, and the relative attractiveness, notice I said relative attractiveness of investing in Australia is diminished. That's bringing the Aussie dollar down. That's a good thing. That's a good thing for Australia in the longer term, a lower exchange rate.
Unless you're going overseas next year for your gap year.
Oh, as students potentially be. But in terms of getting a job and providing long-term sustainable growth, it is a good thing.
And the rebalancing of our economy, of course.
Yeah.
And then we'll look at the emerging markets here, and we're seeing some, as you would expect, some different occurrences in the cash rate for these countries. Still quite low. We can see that Russia's all over the place. Probably not a great surprise. I'm not too up on Russian policy makers and why they've done that. But you'll see emerging markets are always going to be a little more volatile because of the transition that they're going through.
One of the reasons behind the Russian high interest rates is they're struggling to keep control of the ruble. It's basically devalued, depreciated significantly because of the sanctions being placed on their economy, and as a consequence, interest rates went up to try and underpin their currency. And it's a poor way of managing your currency, but sometimes you don't have a choice. And if you want to see external instability in action, you look at Greece and then potentially look at some other of these emerging economies. So the key question, I know in my class we discussed today, and I know you've showed me an article, you've shown your class a similar one about, has monetary policy lost its ability to promote growth? And here we're really talking about weaknesses of monetary policy, and the argument or the conclusion we came to is no, it hasn't. The cash flow, the asset price effect, the exchange rate effect, the cost of credit effect, all still working. But they're working against some pretty strong headwinds. And you do need to know about these headwinds, students. You need to know how falling commodity prices affect or causing low growth, how the high savings ratio relatively to previous years, and particularly low wages growth, is stunting consumption spending. You need to know that the mining investment boom, mining investment phase has well and truly ended, yet, as Mr. Smith was saying before, we haven't seen the rebalance into other areas of the economy. And then, of course, there's fiscal policy, and this is where we need to diverge a little bit and talk about fiscal policy and the relationship between, we haven't got a slide on that, but we can discuss it. Is it compatible? Is it conflicting?
Well, you'd have to say it's still conflicting. And if we look at the last 2 years, particularly last year's budget, they tried to take a hell of a lot of money out to get back their goal of fiscal consolidation. And, there was a fiscal emergency and all this sort of stuff. So even this year's budget's been, as we've discussed, mildly contractionary. And if you've got such expansionary monetary policy, but you've got fiscal policy possibly not doing its job in terms of assisting or being fully compatible, then the government's basically leaving monetary policy to do all the heavy lifting. And perhaps that's why we are at 2%, because they've got such a political, as well as an economic goal, a political goal of getting the budget back to surplus.
And you'll even hear, Glenn Stevens, if you read between the lines of some of the things that have come out of the Reserve Bank, he's been encouraging the government to start investing, particularly in infrastructure. And they refer to weak public sector demand or flat public sector demand. And it's not just federal governments, it's the federal government, it's state governments as well. There's a risk aversion to taking on government debt at the moment. And we've discussed before what we think government should be doing, and obviously what other key commentators are referring to is the government has an opportunity to borrow money at this point in time and invest in infrastructure, and it's not taking up that opportunity, and that's perhaps dragging the economy to a slower rate of growth than what it is.
Yeah, so to finish off, there are some elements in the most recent budget, such as the infrastructure in Northern Australia, that are complementary to current monetary policy, but there's certainly probably not enough in there that you would describe it as completely compatible.
No. And I guess the only other comment here before we move off this slide is some of the weaknesses of monetary policy come through here. Its blunt nature, the fact that it can't, for example, distinguish between the housing market we were talking earlier about in Sydney and Melbourne and the non-mining investment sector. They would like to see a lower, we need to see interest rates low to promote business investment, but at the same time we don't want to overstimulate the housing market. Sectors of the Australian economy, Tasmania's economy is struggling, whereas Victoria and New South Wales are growing stronger. Yet we have one interest rate across the whole nation, and that blunt nature is a bit of a weakness, and that's one of the concerns here again in its ability to stimulate activity in different areas. So, where's monetary policy to from here? Where's the economy to from here, Mr. Smithers, to finish up?
So we are seeing some positive signs in, and Mr. Burns referred to these as green shoots in the the lower household savings ratio, some increase in spending in retail and that sort of thing. And I think that'll leave the Reserve Bank quite comfortable with rates as they are and not seeing the need to provide further sort of stimulus to the housing market. And they're hoping that the medium-term nature of monetary policy, that this 2% rate, if they leave it there, that it'll kick in and that households will slowly build confidence and that will lead to a gradual rise in consumption. They are talking, longish term, and a lot of commentators are talking about we'll have to get used to rates of growth that are just a little under our recent averages. So particularly Gittins has spoken about this, and perhaps that's what's going to happen. I don't see a willingness of the Reserve Bank to go if they went, one more rate cut down. But I don't think they think that's going to turn confidence around.
No, and confidence has picked up a little bit. I think the Reserve Bank's pinning an awful amount on the growth in Australia and the stimulatory effects of the depreciating currency, and they've been banging on about getting the currency lower for a long time. It's now down. It's probably got further to go, some people are arguing. And as a consequence, we're hoping, we're expecting, and we are starting to see an increase in particularly service exports. Tourism has grown already. The highest rate, interestingly, of international students since 2009, I'm led to believe. So we're seeing an increase in demand for our service exports. We're starting to see an increase in industries that compete with imports. They're starting, and tourism's a classic example, known as the tradables in the game, industries that are affected by the dollar. And Mr. Smithers, I believe you're heading off to America later on this year, is that correct?
That I am, and very nervous.
And very nervous about the falling currency. But if it falls much further, he may decide to stay within Australia and holiday, and that adds to our net external demand because it keeps the money within Australia. And this is a very simple but real example of the stimulatory effects of a depreciating currency. So I tend to think things will start to pick up over the course of the next period, although it does depend a lot on what the government does in terms of fiscal policy.
Are we at the bottom?
Yeah, we're at the bottom, in my opinion. We're at the bottom. Will be interesting to see as the rest of the world start to lift their interest rates, and that's particularly America, the currency will fall. I think we'll see a currency around 65 US cents again in the next 12 months. But we'll see.
All right.
I think we're done.
Good luck on Tuesday, students.
Good luck.